EPK Capital presents Deep Dive on GE Aerospace, GE. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your host, Rutvik. In this series, we analyze one company each day based on the Security Analysis by Benjamin Graham. Today we are going to talk about GE Aerospace, GE. Before proceeding, it is important to state that this report is for educational and informational purposes only. It does not constitute financial advice, and it is not a recommendation to buy or sell any stock. All investment decisions should be made after conducting thorough personal research. Right now, as you are watching this, there are nearly 1 million people in the sky, and there is a good chance their flight is powered by technology from one company. That company powers 3 out of every 4 commercial flights and 2/3 of all U.S. military combat aircraft. This is not the sprawling, complicated General Electric your parents knew. This is GE Aerospace, a newly independent, laser-focused titan of aviation that has just completed one of the most significant corporate transformations in modern history. But with the stock soaring since its launch, the big question is this a generational buying opportunity in a world-class company, or is all the good news already priced in? In this video, a deep dive, unbiased analysis will be conducted to find out. The analysis will cover its history and leadership, dissect a decade of financials, run it through the legendary Benjamin Graham's valuation model, weigh the bull and bear cases, and look at the important checks every investor needs to know. The company and its captain, a legacy reborn, a storied past, a focused future. To understand GE Aerospace today, one must appreciate its legacy. This is a company that has been at the forefront of aviation since its earliest days, building America's first jet engine, the IA, back in 1942, and consistently pushing the boundaries of flight ever since. For decades, however, this aviation powerhouse was just one part of a massive industrial conglomerate. That all changed on November 9, 2021, when General Electric announced a landmark decision to split itself into 3 distinct publicly traded companies, each focused on a key growth sector: healthcare, energy, which became GE Vernova, and aviation. This great unwinding culminated on April 2, 2024, when GE Aerospace officially launched as a standalone company. In a symbolic move, it retained the iconic GE stock ticker, signaling that this aerospace business is now the core of the original enterprise. Leadership at the controls: H. Lawrence Culp Jr., a central figure in this transformation and a key part of the investment thesis, is Chairman and CEO H. Lawrence Culp Jr. Appointed CEO of the parent company GE in 2018, he took the controls of GE Aerospace in 2022 to personally oversee its launch. Culp's reputation precedes him. He is widely respected for his tenure as CEO of Danaher Corporation from 2001 to 2014. During that time, he executed a remarkable feat of value creation, increasing both the company's revenues and its market capitalization 5-fold. This track record is not just a historical footnote. It is evidence of a specific and repeatable skill set that he has brought to GE. This leadership is about more than just a title. It is about implanting a proven operational philosophy into the company's DNA. At Danaher, Culp was a master of the Danaher Business System, a world-renowned culture of lean manufacturing and relentless continuous improvement. He is now deploying a GE-branded version of this philosophy called Flight Deck. This is not just a corporate slogan, it is the core mechanism for improving efficiency. A tangible example of this in action involved a key supplier for the LEAP engine who was struggling with production bottlenecks. By applying lean principles, the team identified and eliminated an unnecessary hand-finishing step, saving precious time and materials and resolving the issue. This systemic approach to rooting out inefficiency is fundamental to Culp's strategy for expanding margins and cash flow, providing a much stronger foundation than a turnaround based on personality alone. Decoding the financials, a 10-year turnaround story. Context is key. The tale of 2 GEs, Analyzing the last decade of GE's financials requires separating the past from the present. The numbers from 2015 to 2022 reflect the old, debt-laden conglomerate, burdened by struggling divisions like GE Power and massive liabilities from its financial arm, GE Capital. The staggering net income losses seen in years like 2018, when the company lost over $22.8 billion, are artifacts of this legacy structure. The data from 2023 onward tells a new story, one of a focused, recovering, and now independent aerospace business. The narrative is one of radical simplification and renewed financial discipline. Revenue and profitability trajectory. The revenue trend clearly shows the effect of these divestitures, with annual revenue declining from peaks of over $100 billion to the current range of approximately $35 billion to $40 billion. This is not a sign of a collapsing business, but rather the result of shedding non-core assets. In fact, the core aerospace business has shown a strong recovery, with revenue growing 21% in 2023. The most dramatic part of the story is the swing in net income. After years of multi-billion-dollar losses, the company turned a corner, posting a net income of $9.1 billion in 2023 and $6.5 billion in 2024. This profitability is reflected in strong underlying metrics. The company's recent net profit margin has been in the range of 16 to 18%, and its return on equity has been exceptionally high, at times exceeding 30 to 40%, both of which are hallmarks of a high-quality, efficient business. The great deleveraging, a balance sheet transformation. The most critical element of the turnaround story is the transformation of the balance sheet. The reduction of GE's debt is more than just a financial cleanup. It is a strategic liberation. For over a decade, the company was constrained by its debt load, with cash flow directed towards servicing interest payments rather than investing in growth or returning capital to shareholders. Under Culp's leadership, the company has shed over $100 billion in debt. Total long-term debt has plummeted from over $134 billion in 2017 to under $20 billion today. This deleveraging has fundamentally changed the company's risk profile and unlocked its ability to aggressively allocate capital. This is not a theoretical benefit. It has enabled a new capital allocation framework where the company plans to return approximately 70–75% of available funds to shareholders through dividends and buybacks. In 2024 alone, GE Aerospace returned over $6 billion to its shareholders, an action that would have been impossible with its old balance sheet. This shift from a defensive, survival-focused company to an offensive, growth-focused one is the single most important story told by the financial statements. The value investor's lens, a Benjamin Graham valuation. To assess the stock's value, it is useful to apply the principles of Benjamin Graham, the father of value investing. Graham's core philosophy was to buy stocks with a margin of safety, treating the market not as a perfect judge of value, but as a manic-depressive business partner named Mr. Market. The Graham number, a strict test for defensive investors. First, a quick check using the Graham number. This formula was designed for defensive investors to identify stocks that are cheap on both an earnings and an asset basis. The formula is the square root of 22.5 multiplied by earnings per share and book value per share, reflecting Graham's belief that a stock's price-to-earnings (PE) ratio should not exceed 15, and its price-to-book (PB) ratio should not exceed 1.5. Compared to a recent stock price of around $21.66, this result is clear. By Graham's strict criteria for a defensive stock, GE Aerospace appears significantly overvalued. This does not mean it is a bad company, but it indicates that deep value investors would likely pass on it at current prices. The intrinsic value formula, valuing a growth company. Graham also developed a formula for estimating the intrinsic value of growth companies, which he later revised to account for prevailing interest rates. The revised formula is V EPSX A8.5 plus 2G X 4.4 here. V is the intrinsic value. EPS is the trailing 12-month earnings per share. G is the expected long-term growth rate. 8.5 is Graham's base PE for a no-growth company. 4.4 is the historical average yield of high-grade corporate bonds. And Y is the current yield on AAA corporate bonds. The inputs for this calculation are EPS TTM 7.06. G, growth rate. This is the most subjective variable. While some analysts forecast long-term growth as high as 15.8%, a more conservative estimate of 8.2% per year will be used to maintain a margin of safety, in line with other market forecasts. Y, current 8AA bond yield. The current yield on Moody's seasoned 8AA corporate bonds is approximately 5.4%. Plugging these numbers into the formula, VQual 5.47 or 6, 8.5 plus 8.2, 4.4 143.07. Based on Graham's conservative growth formula, the intrinsic value of GE Aerospace is around $143 per share. This too suggests the stock is trading well above its calculated intrinsic value. This stark difference between the Graham valuation and the current market price highlights a fundamental conflict between investment philosophies. Graham's models are quantitative and backward-looking, emphasizing historical earnings and tangible assets. They struggle to properly value intangible assets like technological leadership, brand reputation, and, most importantly, GE's massive, locked-in services backlog of over $170 billion, a valuable asset not fully reflected on the balance sheet. Modern analysts and the market, in contrast, are pricing GE Aerospace based on the quality of its wide economic moat, the predictability of its high-margin services revenue, and its future growth prospects. They are willing to pay a premium for this quality, which Graham's formulas penalize. An investor's conclusion about GE's value, therefore, depends entirely on which philosophy they subscribe to. The bull case. 1. Dominant market position and wide moat. GE Aerospace has an installed base of approximately 44,000 commercial and 26,000 military engines. This massive global fleet creates enormous barriers to entry for any potential competitor. 2. The razor and blades. Model. Approximately 70% of the company's revenue comes from high-margin recurring services. Once an airline purchases an engine, the razor, it is effectively locked into decades of service, parts, and overhauls from GE, the blades. This business model provides highly predictable and profitable long-term cash flow. 3. Financial fortress. The balance sheet has been transformed. With debt now at manageable levels, the company is a cash-generating machine, projecting free cash flow of over $8.5 billion by 2025. 4. Proven leadership and execution. Larry Culp's flight deck lean operating model is already proving effective at driving efficiency and expanding profit margins across the business. 5. Massive backlog and industry tailwinds. The company sits on a services backlog of more than $170 billion. With global air traffic expected to double in the next 20 years, the long-term demand for both new engines and aftermarket services is secure. This outlook is supported by overwhelmingly positive analyst sentiment. The bear case. 1. Lofty valuation. The stock is trading at a high PE ratio of over 38 and a price-to-book ratio of over 14. The Graham analysis confirms this premium valuation. The market may have already priced in years of perfect execution, leaving little room for error or disappointment. 2. Execution and supply chain risk. The surging demand for air travel is putting a significant strain on the entire aerospace supply chain. Any failure to deliver engines on time could frustrate key customers like Boeing and Airbus, potentially hampering growth. 3. Catastrophic design risk. While remote, a systemic flaw in a major engine design could be financially devastating. As seen with competitor Pratt & Whitney, such an issue could result in billions of dollars in charges for recalls and repairs. Because GE assumes most of the financial risk on its long-term service contracts, the impact of such an event would be immense. 4. Intense competition. While GE operates in a near duopoly, it faces fierce competition from RTX's Pratt & Whitney, Rolls-Royce, and Safran. The battle to develop the next generation of more efficient and sustainable aircraft engines is a high-stakes, multi-billion-dollar affair. Important checks: governance and global standing, clearing the air on past controversies. Investors looking at GE's history will find legacy issues. The most significant was a shareholder lawsuit alleging that the old GE misled investors in 2017 about the financial health of its power and insurance divisions. It is important to note that this lawsuit was settled for $362.5 million in January 2025 and relates entirely to business segments that are no longer part of GE Aerospace. While it serves as a reminder of the importance of transparent financial reporting, it is a resolved historical issue of the former conglomerate. More recently, the company resolved allegations of gender-based hiring discrimination at one Vermont facility for $443,000 as part of its ongoing corporate governance. A global powerhouse, market position. GE Aerospace's leadership position in the global aircraft engine market is undeniable. The industry is effectively an oligopoly, with GE and a few other players dominating the landscape. A cornerstone of this dominance is CFM International, its 50-50 joint venture with Safran of France. This partnership produces the LEAP engine family, which is the sole engine option for the Boeing 737 MAX, and one of two options for the Airbus A320neo. These two aircraft models are the workhorses of global aviation, making the CFM joint venture a critical pillar of GE's market power. Conclusion and disclaimer, synthesizing the analysis. So, what is the final verdict on GE Aerospace? The analysis reveals a company with two distinct stories. On one hand, there is a world-class industrial champion with a near-impenetrable competitive moat, a fortress-like balance sheet, a massive backlog, and A-list leadership driving operational excellence. The fundamental business is, without a doubt, exceptional. On the other hand, there is a stock that, by traditional value metrics, like the Benjamin Graham formula, appears significantly overvalued. The market is pricing this company for near perfection, rewarding it for the incredible turnaround story that is now largely complete. Final, neutral stance. Ultimately, an investment in GE today is a bet that its wide moat and its execution under Larry Culp justify its premium price tag. It is a classic case of a wonderful company that may or may not be at a wonderful price. The conclusion will depend on an individual's own investment philosophy and tolerance for valuation risk. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.